Okay, so very good morning. Welcome to the briefing then for Tuesday the 19th of July. Just as I start the briefing, then it's just gone 8:30 now here in London and seeing a bit of risk-off sentiment. So the DAX back sub that 10,000, which did provide some degree of support yesterday afternoon for seeing a bounce off that. So technically a bit of a break lower there. It comes after a very kind of subdued day that we're seeing on Monday. The dollar is also seeing a bit of strength, which kind of fits with the risk-off theme, and that's also just pressured cable. You can see here just testing around that 132 level most recently. I think just taking a quick recap of yesterday's price activity, it was one of those sessions where I think it's about understanding the day in itself, and if it's a quiet day, then just identifying ranges and looking at the market more that way, rather than trying to chase real price movement, so to speak. I mean, the only real asset that saw more of a definitive move yesterday was oil, when it initially started to break lower. I think it went through that S1 level, and then the $46 handle did prompt a bit of selling at the time. But otherwise, just taking a look at things like the S&P for one, the actual range in the S&P, it was 0.5% on the day. It's actually the narrowest trading range we've had since around the 26th of May, and it's this is against a average this year of 1.5% for the S&P. Just looking here on the bottom left, just in regards to the S&P, and this encapsulates the price activity from yesterday. It's quite interesting to look at the S&P at these types of levels, because I did see a stat in terms of US indices. I mean, in terms of the Dow, for example, the Dow's now rallied for 7 days in a row, adding 3.5%. The sequence of gains last extended to 8 days. You'd have to go all the way back to the 12th of March of 2013. So when you start looking into context of the kind of powerful move that we've had to these all-time highs in US equities, and just looking at the S&P here since around the beginning of July, when we had that aggressive move once we've got above 2100 and the previous all-time highs, after hitting around 2170 type levels, we have started to consolidate over the course of the last 3 days or so. Looking at yesterday in more detail, this is kind of your session right here between these two levels, and again, this is only 0.5%. Just looking at it on this basis, then we'll see this S1 just looking at first test now as we speak, but again, that 52 and 3/4 will kind of define the range from yesterday to look out on the downside. And again, likewise, the DAX this morning, looking at the range from yesterday, also just a tight really. On the downside, it's kind of that 99.51.5 on that initial blip that was seen. It's back on the 14th, the 15th, all the way into yesterday was around these levels. So the break of yesterday afternoon was low then, the DAX really in that 10,000 acting as a bit of a trigger for the move lower. But we have had a couple of earnings after market. Something I was talking about yesterday was IBM, which is often seen as a bit of a bellwether. So starting off with them after the close, their revenues were not quite as bad as feared, albeit it was another quarter of negative revenue growth. This was the 17th consecutive quarter that revenue has fallen in year-on-year terms, and yet that exceeds expectations. I saw an interesting stat about Bank of America, which we saw yesterday. They also beat expectations. Their EPS was 36, about 32 cents on the street. But Bloomberg consensus forecast at 36, or was at 36 just 2 weeks ago. So Bloomberg consensus got lowered from 36 cents to 32 cents just 2 weeks ago. So when you say Bank of America beat, well, it did beat by 4 cents, but it would have been in line if this was just 2 weeks ago. Kind of a good example how last minute analyst revisions can help boost the initial headline numbers. So IBM then, as I said, 17th consecutive quarter that revenue had declined on a year-on-year basis. However, it was better than expected. The EPS also beat, and so they were marginally higher in aftermarket trade. However, one of the kind of famed stocks as FANGs, which is those kind of social media sentiment-related stocks, which were big winners last year. Netflix disappointed on their subscriber numbers last night, and it sent their shares down 17% in aftermarket trade. These will be ones to watch in terms of Amazon when they report, Facebook, those other names that make up those kind of that particular social space, to see how they perform, as they're quite a good benchmark for general risk appetite in the morning. On that theme, Goldman Sachs is the next kind of big bank to look out for from an earnings perspective. Seen this article in the FT this morning. So 5 things to watch from Goldman Sachs. First of all, profits up a lot, they say, but a caveat. Although Wall Street is expected to produce, or Goldman is expected to produce earnings per share of $3.09 for the period. That's up from $1.98 a year ago. That's a massive jump. But that's because they were naughty boys and got a massive multi-billion litigation related charge last year. And so, don't be fooled by these kind of big jumps in the likes of Goldman's headline EPS, because a lot of that is just the fact that accounting-wise it's dropped out of a substantial litigation charge they had last time round. FICC is something which you should always look out for, on a term you should be familiar with when looking at dissecting the accounts of investment banks. That's their fixed income, currencies and commodities division. It's kind of seen as the real engine or heart of investment bank activity, or at least historically it was. That fell to its lowest level since the financial crisis at the end of the first quarter. So analysts again will be looking to see how Goldman fares. Now, you might think, some of the younger interns might think Goldman Sachs is kind of the bellwether, the top-tiered bank of the group, if you like, on the street. However, since the fourth quarter of 2009, Goldman has now dropped from first to fourth place in terms of their fixed income, currencies and commodities revenues. They're now behind JP, Citi and Bank of America. Next area to look out for: how did the lending and investing division hold up? So a rag bag of businesses involving Goldman placing bets with its own capital. Again, they've struggled in that particular division. So these will be the kind of underlying metrics to keep an eye on to gauge the health of the bank from sort of inside out, so to speak. Brexit, obviously from the having operations in the UK point of view, that'll be interesting to see how they, if they make any changes or at least forecast to do so, and then that kind of rolls into headcount. Banks, as you well know, very quick to hire and fire in good and bad times. So it'd be interesting to see that, if they are becoming less profitable, then how many heads have got to roll in order to kind of balance the profitability of the bank. Just moving quickly away from this for another second here, just seeing a bit of a further extension of dollar strength. The Dixie's just moved above the high print from yesterday, or testing those levels. So we're up 0.2% now. So just shortening the time frame on the cable chart here, top left. Just starting to see that, obviously 132 already gone, and now that S1 being more firmly tested here on the downside, with euro dollar also just seeing a bit of added pressure. Just speaking about equities and earnings that we're seeing at the moment, another article I saw on the FT this morning, from a slightly more broader macro perspective at least, talking about outflows accelerating from US active funds. If I just skim down to the chart here, you can see the difference between active and passive funds. So the darker shade being active, you can see there's been a trend certainly for a long time here, this 2-year kind of graphic. So passive, I guess, tends to be more stable, but certainly in times of uncertainty and volatility, this is when you see active withdrawals and a move back into more passive funds, i.e. just playing the more safer game in otherwise uncertain economic environment. And you can see here that outflows, these are kind of the largest that we've had. Looking at this chart, this is the biggest outflow on this graphic is happening at the moment. So the shift of assets from actively managed funds at low-cost index trackers accelerated last month. It's now at the worst outflows since the financial crisis. So 21.7 billion flowed out of actively managed US equity funds in June, the worst monthly figure since October of 2008. So in terms of some of the longer play money, certainly it is starting to peter out in terms of being actively involved in this market. So, for the new guys, when you're kind of asking yourself, why aren't I being successful trying to trade these markets, then, you're not the only ones, and these are quite unprecedented times in terms of volatility. I mean, yesterday was a particularly quiet day, range bound, but, this extraordinary monetary policy environment we're in, where equities go to all-time highs when fundamentally economies are very weak, just goes to show it's a fairly hard market to play at the moment, given the market's largely prepped up by central bank action. Okay, moving on, a quick look in towards the calendar for today. So there are a couple of key data points coming out. First of all, just sharing with you here UK CPI. So that's coming out 9:30. These are June numbers. I don't think they're going to have too much of an overall influence on what we might see in August, but the market certainly, not only this morning with cable back down through 132, we've had some dovish commentary of late from MPC members, that's excluding Martin Will, who spoke yesterday, but overall prepping up for August. So if we got the kind of risk here is if we get an upside number. So if prices were already kind of moving up on the premise of kind of concerns around Brexit, or if it does take into part a couple of days of June post-Brexit, it'd be interesting to see the feed through that's had on prices. And if we start to get upside figures of 0.5 or above on a year-on-year reading, then the ability of the Bank of England to start cutting rates and doing very expansive easing policies might be questioned. And I'd be mindful of any sort of upside spikes that cable might be vulnerable to at the moment, as we saw yesterday when that hawkish comment from Will was made, given the market positioning is more for easing and so further sterling weakness to come. So that's at 9:30. But out of Europe, we also get one of the biggest numbers on a monthly basis from Germany. This is your German ZEW economic sentiment. You can see here we had a massive improvement last month. It rose to 19.2 in June. Beating consensus at the time was only 4.7. It was the highest reading since August of last year. So just given, again, Brexit, the kind of changing on the economic environment, it'll be interesting to see then after that stellar reading we had out of Germany, do we see a bit of a pullback back to these more depressed levels towards flatlining. So that will be at 10 o'clock. So 9:30 and 10 o'clock, your main kind of data releases. Otherwise, just to wrap up the rest of the things that we've seen, for any of the FX traders, if you are looking at Aussie dollar, you'll see that Aussie is trading weaker. You did have RBA minutes overnight. The central bank stated they would be willing to adjust policy further in August. That coupled with the fact that WTI is down around 16 cents this morning, obviously a commodity-linked currency, a dovish kind of comment or direction possibly to come from the Reserve Bank of Australia, means that Aussie is on the back foot this morning as well. Let me just get my calendar back up. So other than those data points, in the US, again, it's fairly quiet. You've got housing starts and building permits It's only really if they're substantially out of line that I'd expect those to move the market. More so, I'd be keeping an eye on Goldman's. They'll be reporting pre-market, see whether they keep to the same tone as the banks we've already seen report, which is generally lower of profitability, kind of weakness in the bank, but beating low forecasts on the street. Be interesting to see as well as some of those tech-related names. Again, IBM was slightly higher after market following, although contraction again in their revenues year on year, a slight beat on expectations. But Netflix and some of the more sensitive, I'd say, social media names could be ones to watch. The Netflix fell substantially, close to 20% last night. Oil numbers, the Cushing from Genscape didn't really give us too much of a clue yesterday. I think it was a build of around 26,000. That's pretty marginal. So you'll be looking out, and you have to wait till 9:30 this evening to catch the API oil inventories to then set the tone for the DOEs on Wednesday. Speaker-wise, we're pretty quiet. Broadbent from the Bank of England of a neutral stance will be speaking. That'll be just after 3 p.m. this afternoon. Okay, that wraps up then your briefing for this morning. Have a good session. Next up, you've got the UK figures coming out in around 40 minutes time. Enjoy your day.